everybody for being here today on this Saturday event. And we're going to dive into how to play earnings, kind of an earnings game plan that I go through each quarter. So a lot of crazy stuff will be coming up. The markets have been pretty nuts anyway, but now we're getting earnings season, so it's just going to add to that volatility. So that being said, let us get started. So, with each new earnings season is an increase of uncertainty and volatility, and that's what we're going to learn and try to take advantage of it. I'm going to go step you through a number of different strategies that you can incorporate to, play these types of earnings volatility plays, such as a question from Kumar as far as, when direction is uncertain with lots of volatility, what are the strategies? So we're going to look at that here today. And again, thank you for being here. And a little background on myself. I've been actively trading markets, for over 40 years and options for over 30. I started my trading journey back in the 80s on the oil side. Was fortunate to get into a training program for an oil company that would actually train you to trade crude oil. So I got into that with a company called Coastal Corporation out of Houston. They had a bunch of refineries all over the world. And so had that opportunity. Spent a couple of years out in Singapore trading products and oil out there, and then ended up with a company at the time, one of the largest oil trading companies in the world, Trans World Oil, which was located and based out of Bermuda. And Trans World, Fibro, and Mark Rich were the three largest at that time. So got the fortunate opportunity to go with Trans World. Spent about 17 years there, ran the trading desk out of Bermuda for 10. And that's where I started trading options back in 1987. So it's been an ongoing journey. And, one thing is with trading, it's a constant journey of learning. You never learn it all. And again, thanks everybody for being here. So we're going to get into some really interesting earnings type option strategies to use. So let's get started. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. One second. Now, have you noticed how earnings are horrendous and a stock goes straight up? Or you can see that earnings are off the chart fantastic. You think they're great and the stock tanks. So this is what I call the earnings confusion. And that's what really, we have a lot of confusion in the markets as we currently are, without earnings. But once you get into earnings, it makes it even more confusing. Now, when a company has an earnings conference scheduled, to announce their earnings results, many times there's going to be speculation not only into the accuracy of their projected earnings, but also into other factors. They may say, okay, we're going to do some cuts with layoffs of people, or maybe we're going to drop a dividend, or maybe we're going to start, adding additional stores, whatever. So there's a lot of uncertainty going in, and then, there's also things that can happen during these conference calls that also kind of surprise the market. So that creates even more uncertainty and volatility. Now, the uncertainty typically causes this increase in volatility in the shares of a stock. And that's really the big diamond in the rough. So it's this temporary parabolic rise in volatility that spikes the option prices that we're looking to take advantage of. So what happens is traders, tend to stay on the sidelines as you're going into the days leading up to an earnings conference call because of all that uncertainty. So, you're not going to trade the stock. You don't know what's going to happen. You're confused about what could happen. And so what happens is that you get call buyers will come in starting to swap out their long shares of stock to limit some of their exposure there, but they can still participate in a rise should the shares move higher, but they want to limit that potential loss should the shares move lower. So they swap out stock for options. So that creates that additional demand, and that's going to increase the implied volatility from all that demand coming in. Now, additionally, you have put buyers that are also going to start coming in, forcing those option prices higher as they try to protect their positions from any major downside movement. So it's all this concentrated option buying that in many cases will drastically expand the volatility levels of a stock as it trades or moves into its earnings release date. So as an individual trader, we can take advantage of all this uncertain volatility in order to capture those profits from that increased implied volatility. So we can do it no matter what the crazy earnings reactions are if we just know what are the right setups and strategies to use. Now, step one, I look to identify and qualify a particular stock by looking at its past history, its performance, the probabilities of what it's done in the past as it specifically heads into its earnings release date. So I want to look to find stocks that have an earnings release during the weekly option expiration. So we want to be able to take advantage and use weekly options because of all the different, benefits that they add to your trading, because they're, going to be less time decay as far as, they're going to be cheaper, they're going to have the higher volatility to it, but we'll discuss that a little bit. But weeklies are what we want to incorporate to do these types of trades. Now, then we want to look at it, evaluate the past performance of a specific stock. We want to see what it has done in the past as it moves closer to that earnings release and even after. So we can look at past performance, and we can then look at what it's done prior to the release, kind of get the statistics of what it typically does at the release, and then is there any kind of post-earnings move that this specific stock may potentially have. Now, when you're prepared for all of this dramatic increase in the volatility of the stock as it approaches the earnings, you're going to see normally, when we look at implied volatility of a stock, normally there'll be 25 to 40%, as far as the implied volatility of a stock. But when we head into that week of its earnings announcement, this volatility can really move to extreme. So it can go up 2 to 3 times the normal implied volatility, and that is not unusual at all. So we want to be kind of prepared and be able to take advantage of that opportunity. So this really makes a stock potentially a great profit opportunity. That volatility, which normally will double, in some cases is even more extreme than that. So we want to look at that and try to evaluate it, and then put together a list of these types of stocks. So here's an example of this kind of potential benefit from this move into an earnings. So this is NVIDIA, which has been on a tear, but typically it has pretty high implied volatility. But this is an example of, it's going to have its earnings on the 13th, okay? And then the expiration for NVIDIA in this example will be on the 14th, just one day later. So if you look down here, this is NVIDIA. It was trading at 270, and this was going into the day of its earnings release. So it was going to be released on a Thursday after the close, and there's one day at expiration. And you look over here, it shows you this implied volatility here of 114.34%. So normal volatility is, about 35, 40%. So you can see this is about 3 times the normal implied volatility. Now, based on NVIDIA trading at, let's say, 270 right here, going in, the implied volatility based on the dollar amount, theoretically, this implied volatility is saying it could go up $17 or it could go down $17 in one day. So that's a huge range, right? So that's going from this one standard deviation, but typically we'll get even bigger moves than that. So here it was going into the earnings, 114%, normal volatility about 35 or 40. It was traded at 270. Now that's the day of the earnings release. So the next day though, let's take a look and you'll see how this just totally craters and collapses. So here's the next day after the earnings release, and you can see this is what we call volatility crush. So that volatility was at 114% the day before the earnings were released. Now the next day after the earnings were released, it drops down and crushes or crashes back down to that normal implied volatility. So you can see that's what we're looking at, and that's what we can take advantage of. So the volatility crush, and also not only did this have a volatility crush, but there's also a big price spike. So it went from 270 to 291 in one day, 7.5% up. So there are a number of different strategies that we can incorporate to take advantage of either big price spikes up or big implied volatility crush down, or both. So that's what we're going to kind of dive into. So that's a good example of how, what you can expect from some potential volatility crush. So here's what it looked like on the chart. You can see that the implied volatility had been grinding up into that earnings release date right here. So it was trading right here before going into the earnings. It was trading right here at that 270. Okay, so then the earnings were released after the close. And then the next day it gapped up, spiked up to here, and then it kept trending up. So huge price spike up, but also the implied volatility collapses down. So it's always going to collapse down, and whatever stock you're looking at will always go up in implied volatility, some more than others. So we can gauge that, we can look at that and look at the history to see which ones are the ones that are more prone to have these big spikes. So for this reason, it's really important to have a watch list of stocks that you can look at and closely monitor due to the fact that they're not all going to present you an equal trading opportunity. So some are going to have higher implied volatility going in. Some typically maybe have bigger price spikes going in or coming out. Some maybe have post-earnings moves. So we want to look for all these kind of potential tendencies, and we can do that if we look at the history. So remember, the goal is to take advantage of that temporary rise in volatility of your stock, as well as any past earnings performance, and looking at those probabilities as to what it's done in the past. So the three types of earnings cycle trades that I've kind of identified. One is what can be a trend trade into the earnings release. So typically, as you move into an earnings release date, so let's say let's say for example, Amazon or something will be coming up mid-April, but say Amazon right now is trading at about 100. All right, so typically what happens in a bullish market, the tendency is for the stock to kind of trend higher into the earnings date release. So let's say this is this week's date, so we're here the 1st of April. So we're 1st of April, and then Amazon is going to have earnings released somewhere about the 20th or something like that. So what typically happens is that you'll get this potential to grind higher, and not only will you get prices a lot of times grinding higher in expectation or anticipation that earnings will be good, but you're going to get the implied volatility grinding higher too because of all that buying activity coming in for calls and puts. Now, in some cases, we may see it moving down, but what you're going to always see is the volatility, implied volatility is going to be always going up as it's heading to that week of the earnings release, okay? So that's one thing that you can take advantage of, okay? We'll look at that. And then the next trade that we're going to look at, and this is the one that we're going to be really focused on here today, are non-directional type trades where you can take advantage of that implied volatility spike that normally, doubles, maybe sometimes triples, but we know that after the release, it's going to go back down to what's normal. So we can take advantage of that with various different non-directional trading strategies using options where it doesn't matter if it goes up or down because we're playing volatility to collapse. And then the third type trade is a post-earnings release trade. So once the earnings release is done, that uncertainty is taken out, a lot of stocks tend to have a tendency to trend after the earnings. So that's another potential opportunity. So they're actually, with earnings, it's scary, but crazy. But, if you understand what's going to happen and embrace it, there are a lot of opportunities that are going to be out there for you. So here's a really good example on CRM. So this one actually had all three of these types of earnings trades potential. So here with CRM, you can see it was trade one would be a kind of an earnings trade as it trends into earnings. So you can see here a price is starting to trend higher. Okay, so the earnings release will be right here. Okay, right there. So price is trending higher, but also the blue line down here is the implied volatility. Now it's also trending higher. The purple line is the historic volatility. So you can see it's been flat and it comes down, but the implied volatility into earnings is really starting to stretch to the upside. So what happens is, one, you get the delta increasing, price going up. Okay, so price is increasing. So let's say you bought an option in this series here, the release series. So let's say that's the 21, just for number, say that's going to be the release, earnings will be the release, the 21 of April will be the option series. And so this is like starting out April 1 right here. So what you would look to do in this type of trade, you go out and you would buy options in this series. Okay, so let's say you think it's trending up. So you go out, you can buy calls in this series. Now, not only are you going to get the benefit of the price going up, okay, you're going to also get the benefit of implied volatility going up on your options. So you get a double boost to the price of the option. So let's say you bought this option for $100 here, you know, and then you get the benefit of price going up plus implied volatility increasing that price, and it could end up being $120 by the time you get to that earnings announcement. So that's one potential way to take advantage of it. So that's a great opportunity there, just to realize that that's going to be a potential move on these types of trades. Now, the second one that we're going to be really looking at is to take advantage of that really big spike in the implied volatility. So we don't know which way it's going to go. We don't know if the stock price will go up after the earnings are down. So we want to do something non-directional. So we'll talk about that. But you can see here, it released its earnings right here, and look what the price did. It went crazy up and down. It spiked up, spiked down. But the one thing that was for sure that we knew was going to happen, implied volatility collapsed. All right, so if we don't even know price direction, we can still take advantage of that with certain strategies. And then the third potential opportunity is a post-trend trade. Okay, so some stocks have a tendency to trend past the earnings release. So either trend up or trend down, depending on what the earnings were. So we can look at that historical, information based on past probabilities of, what it's done, or past, what it's done actually in history. So these are the three types of things that you can look for to play during an earnings season. Now here's one more example to kind of illustrate the implied volatility. So here's Nike, and you can see here Nike in this example way over here, price is trending down, but the implied volatility is trending up, and then after the date of the release, implied volatility collapses. So here again, Nike's trending down on price, but implied volatility is trending up, and then the release date here, volatility collapses. So, that's what is always going to happen. Volatility will always go down after an earnings. So the next thing is what I like to look at is kind of what I call my checklist to systematize a trade setup process. So you want to try to make things as mechanical and systematized as you can to kind of take your emotions out of your trading and make everything kind of step-based, mechanical. So let's go through kind of some things that you can consider putting into your kind of checklist. So first off, when we're looking at an earnings trade, we want to make sure that it has options to use, weekly options, and it has good option liquidity. We want to be able to able to get in and out with good liquidity. So we don't want something really thin. So that's one definite thing we want. Oh, question: how do you calculate the expected move? Yeah, we can go through that when I get to an example here. Sure, be happy to do that, Dan. So the next thing, it must have pre-earnings volatility. So they're all going to have that, but that's just a must. And then we can go back and look historically what a specific stock has done. So I have a good database that I use for that. Now, the next thing, it must have price movements that on average are going to be greater than 5%. So I look at a number of different things to put together a watch list. So one of the things I look at are stocks that have a move on average of greater than 5%, okay? So greater than 5% up or down. All right, so that's a must. So that's going to give me one type of strategy to use. Then I have a couple other lists where I look to see what specific stocks in the universe have a tendency to move no greater than plus or minus 7% or plus or minus 5%. So the reason for this is I want to take advantage of that implied volatility spike, but I want to make sure that these are on stocks that typically don't have the big price spikes up or down after the release. So what can happen, and a lot of mistakes that traders make, is that they always think, okay, implied volatility is going to go up, so the only thing I can do is I'm just going to sell options to take advantage of selling that high volatility. But there's certain stocks, like you can see last week, Micron, Lululemon, they had these spikes. I mean, Lulu went up 14%. So if you had sold volatility, which was probably still huge on Lululemon, you would have been crushed from that upside spike. So you got to make sure you're picking the right stocks. That's a really important thing. Next, we want to calculate the implied move, okay, the day of its earnings release. So that's going to give us kind of that theoretical implied move up or down where it could go based on what the market model, your option model is telling us. But that's just kind of based on one standard deviation. But typically, a lot of times you're going to see these stocks move greater than that implied move. Then we want to, from the implied expected move calculation, we can then, look at an earnings price target analysis. We can then set our targets to where we think theoretically it could go, and then have a, back into a strategy to use from that. So based on that, we can then select the appropriate weekly option strategy to use, our entry plan, have that together, what's our exit plan, and then get ready to place the trade. So here's an example of some things we can look at. Here's one at Roku. So looked at that NVIDIA earlier, but Roku also is a stock that has a tendency to have really big price spikes and a high implied volatility going in. So you can see here is also the day before its earnings release. So this was like on a Thursday. The earnings were going to come out after the close. So you can see that normal implied volatility for Roku has been really high. In this example, is back about 70. But you can see here, going just one day before the earnings release, it was over 200%. And the implied expected move up or down was $16. So one day only, this thing can move up 16 or down 16, but also it can move maybe greater. That's one standard deviation, but sometimes these things will move too, all right? So then you can see though what happens after that release, it collapses. So the expected move here is 11.64%. So if you're looking, so the question was, how do you calculate your implied expected move? Well, you come over here, there are a number of different things, but on Thinkorswim, it'll give you this number right here, which is based on a straddle cost. And so what that is taking the cost of your call, cost of your put at the money for the option series you're looking at, and that's going to be basically your straddle cost, or that'll be the implied volatility expected move. So in this situation, if you were just to look at the call at the money call for Roku at 137 the put, take those two together, it's going to come out to about $16. So what that's telling you is that it can go up 16 or down 16, and then you take that, divide it by the underlying security, that gives you the expected move as a percentage. So if you look at this as a bell curve, just kind of set that kind of visually, Roku at the money was trading at 137. The option model, putting in the price at the money, time to expiration, 1 day, the implied volatility of over 212%, was giving you the implied move that this could move theoretically based on the model up 16 or down 16, which would be 11.64% up or 11.64% down. So it could go up here by $16 up. So what is that? It could go up, and that's a normal move, but the tendency during earnings is sometimes a lot greater than that. So 137 plus 16, this could go up to 153, okay? Or it could go down by 16, so 137 minus 16, gave me the wrong number, minus 16 is 121. So that would be just kind of a normal implied move up or down, and that would be one standard deviation. But with earnings, these things can all sometimes go 2, sometimes even greater up or down. So that's the crazy, scary part if you're trading these things. But the good part is that if you know what to do, the right strategy, you can sell that implied volatility, or you can do a strategy in this case where Roku tends to have big price spikes up or down. You could trade this for a big move up or down and go with a different direction and not sell volatility. So that's what you're looking at there. And then the next day, so here it was 137. That was on the 7th. The next day it was expiring. and here it was the next day. So it was 137 the next day on the 8th. It was now trading at 127.65. So it was down that almost 1 standard deviation down to 127, and that was a 17.6% move to the downside, plus the volatility collapse. You can see the volatility here was over 200, 212. Now it collapsed back down to the kind of the norm. So these are kind of earnings statistics that I'll look at to kind of give me this kind of information to kind of get an idea of what it's done in the past. So here's Roku. So just looking back at this data, you can see this is, old, but it gives you the implied expected move history here. So typically, Roku's one that has big moves. So this, that August earnings series, expected move was over 10%. The series before was over 11, 14. So this has a big potential moves up or down. Now, what I like to do is then, okay, I take that, but then I want to see what did it actually do on the day of its expiration as far as price. We know volatility is going to collapse, but what does price typically do? So with Roku, you can see one day to expiration the next day, it tends to have big moves. So here it was down 6% or almost 7%, down almost 8, down 6, down 16, up 20, 28, etc. So this can tell you a lot of things to do or not to do if you're looking at trading Roku for an earnings type trade. So based on this, it's probably not a good idea to sell a volatility type play, because if you're selling volatility for that expected move up, maybe to 10 or 12% up like this, well, you can see here it moved up over 20, over 28. So you would have been just crushed straight through your short strike, up she goes, and you're just hemorrhaging from that. So this kind of information tells you not only potentially what to do, but it tells you what not to do. So here's like this, going through the steps a little bit more, you can see putting this into a worksheet, you can see that going back 8 cycles, Roku has a tendency to, here's the implied move as it's going into that's earnings date. So here's all those implied move history going back 8 cycles. So on average, the implied move going into the earnings release date for Roku had been over 14%. But the big thing is, okay, but then what did it really do at expiration the next day in this situation? So you can see if you take that same data where it was at expiration the next day, here it was down almost 7%, 8% down, 6% down, 16% down, 20 up, 28 up, 25 up, 22 down. So the average was about 17. So it shows you that the implied move history is about 14, but in reality, Roku has a tendency to move greater than that. So that'll tell me, okay, I don't want to, do just a simple play to sell volatility. You need to look at maybe some other way to take that advantage of this history that typically has big spikes. All right, so that will give you the idea of which option strategy maybe to use. The next thing are the weekly options, and that's what we want to use. So weeklies are going to do 2 things for you. They take advantage of, the 2 key option pricing components, which is time value and implied volatility. Now, when we get into weeklies, there's little time left in the options. So the cost of these options are going to be much less than further out. So that's one advantage. And then the other advantage is that implied volatility, which spikes going into, the earnings release date in the week of this earnings release. So these are 2 things we can take advantage of. So it's the combination of these 2 components. When we use it correctly, we can create, low cost defined risk type trade setups. And these can, give you a lot of times really great returns, which I kind of sometimes refer to lightning in a bottle. So if you could just bottle it up and do it every time, you could have some great trading opportunities. So this is going to happen for you if you know then which weekly option strategies to use for an earnings trade, how to construct the trade, and then when to trade it. And then this can, really produce some exceptional fast profits from you, from the incredible leverage that you're getting from the options, the weekly options, and from the, earnings, what that can, do as far as a catalyst for the price up or down, or volatility collapse that we know is going to happen. So a lot of different opportunities there. Now, how is this done? So we can compare different strategies, what I call comparative option strategy analysis. So there are about 4 different strategies that you can use. And then what we can do is we can compare the risk reward between those 4 different strategies for a specific stock as it's going to earnings. So, this will then show us the risk reward, the return on our capital at risk between the various strategies that we may be able to incorporate. And then you can select the one that's going to be maybe best suited for your, trading profile, or, the strategy that's going to be basically the best based on this, past performance of a specific stock. So we can look through and use that comparative analysis to do that. Now, the next step, though, is, what are the strategies? And then how do they work? And then which one would you use? So basically, I've kind of put together there are 4 strategies that can be used to capture profits from this extreme volatility strike or volatility increases that surround each earnings season. And there are some others that are best suited for maybe just the price movement. So we'll go through what these strategies are, just kind of give you an idea and to get an idea of how they work. So the non-directional, these are can be used non-directional. So these are non-directional, what I call earnings option strategies. So one is what we call the short iron condor. So this is basically a debit spread, and this structure would be used for price spikes. So if you have a stock like Roku or NVIDIA or some of these others that have these huge moves like Lulu, you would probably want to, if you're going to do a trade non-directional, you would probably want to use this strategy, and it's a debit spread strategy. The other one, the second one, these are all going to be selling volatility, is the long iron condor spread. So this is a credit spread. This can be used to sell volatility for volatility crush. So you're selling volatility in time, and you're taking advantage of volatility crush. The third is a long iron butterfly, so also a credit spread, great for volatility crush. And then the fourth that I'm really going to focus on here is what I've kind of nicknamed the double lightning. So this is a really great spread because number one, it can be used for volatility crush, but also number two is the flexibility it can use for post-earnings trend trade. So this one, all 3 of these are one option series. So you're going to either get it right, it's binary, boom, you get it right, it goes up or down, you capture that, but you only have that week of the option series you're playing. This one you only have one series, this one you do, but with the double lightning, we're going to be able to structure it where we can have the opportunity to take advantage of selling volatility. But if we want to post earnings trend trade, we have a longer duration option attached to it that we can then ride for maybe a trend up or a trend down after the earnings release. And it could be in the next week out or 2 weeks or whatever you want. So that has the flexibility, which makes this a favorite plus. Out of all these strategies, this will be the lowest risk strategy to do. So as far as low risk, meaning the capital that you would put up is going to be a lot less as far as your risk reward versus these other 3. So the risk reward on this one will be a lot less, or be higher with a lot less risk than these other 3. So that's why I really like this strategy. So here's an example of one to use an iron condor debit spread, which would be used for explosive price moves on an earnings trade. So this is an example that was on Amazon. So with Amazon, it typically, you can look back here over these series, looking at these 4 series, looking at the data, it tends to have the implied move going into earnings were fairly elevated, 10% up or down, 6% up or down, 6.4 up or down, 9.3. So on average, the implied volatility was a plus or minus 6.22%. But over the same 4 cycles, you can see that the actual price has been moving more than that at expiration. So it was actually, on average, it was up or down 10%. So this tells you, okay, well, for this one, then maybe we should look at a strategy where we can take advantage of a potential big spike in price. So if you look here, that says price change per 1 day later. So on average, you can see it was up plus or minus 10%. Now, if you look at the worst worst case scenario here, our best, you can see in this October series, the biggest move down was 6.8. So what if we could do a trade setup where all we had to do is, all it needs to do in one day is move up at 5% up or 5% down. We do nothing else. We don't care which direction, as long as it was to do at expiration be 5% up or 5% down. So that's going to be using this long iron condor spread to take advantage of that. So here's how this looks and would work. So you can see here's Amazon. You know, it was trading at 110.96. Expiration was the next day. So on the 28th, before the close of the day, this trade was set up. So it's trading at 103.29. And we were looking for an expected move. Here was expected move up or down of 10.27%. And then actually the next day it closed down 6.8. So here was where it was trading going in. So it's trading right here. So you do this trade setup before the close. The next day it gaps down and it's down here, and then it also traded lower. But you can see the implied volatility collapse, but this was a price spike collapse. So this was one strategy to take advantage of that potential statistic that says that Amazon has potential to have bigger moves. So here was the trade setup that was the appropriate one for this situation. So again, looking back at the data, it said expect to move up or down 10.27%. The trade was set for a move. All it had to do was move up at close, 5% up or down, and that was how it was structured. And so that was for the next day. So it did close down 6.8. So you can see here, this is basically a 113, 116 call debit spread, and then it has a 108, 105 put debit spread. So this is what we call a long iron condor debit spread. So the total risk here is constructing the two spreads is $227. So that would be if it closed outside of your legs here, you would lose 227. But if it closed in here, either if it closed greater, then you make the profit of 73 from the two spreads here. So let me go through that, and that would be a 32% return. So these are typical returns. You're not going to get the huge, returns. Typically, these types of trades where you're selling volatility or doing this kind of structure, you'll get anywhere from 25, 35, maybe 40% returns. But the beauty of the double lightning spread, which we'll go through, you have the opportunity, if you want, to stay with the leg, either long a call or long a put, so you can potentially have a bigger move, bigger potential profit after the earnings release. So we'll go through that one next. But this is a typical way to play this spike. So here was the spread set up here. So you can see it's basically long a call, short a call. So that was done for a dollar cost of $112. Okay, and then if it closed up here above that 116 strike here, that's your max profit. Okay, so that would be $73. Or if it closed below here, below the 108 strike right here, the 105 strike here, you would make 73. So you don't care which way it goes. You just need a move of at least 5% up or 5% down. So that's what you're playing there. So it is binary. You've got that one chance to do it. But that's why it's important to look at the statistics to see if this has been one that has had that probability of either, big price move. So that's one way to play it. Okay, so for that type of trade. Now here's another example of if you're just pure selling volatility. So this would be an iron butterfly credit spread. So this was an example on Nike. So Nike had, again, it's a lot of these you'll see are just kind of one-day trades, which are great because then you don't have to stick. You're in it one day and out the next, just to take advantage of either the price spike or volatility collapse. So in this example, you can see Nike was going into the earnings release after the close. It was trading at 83.66, and the next day was its expiration. So the expected move going in was 4.9% up or down. So you can see Nike one day at expiration trading at 83.66, the implied volatility had gone from kind of normal 30 in that range to 89.79. And here's your expected move, $4 up or down, which would be your, 492 on your implied move as a percentage. So it could go up, basically $4 or down. All right, so what we're looking at here is just to sell, take advantage of that high volatility. And we want to see stocks that don't have a tendency to have big price spikes. So, that's what we're going to look at here. Nike, not thinking it's going to have a big, huge move, that it will stay kind of in the range and we can just sell volatility and profit from that. So the next day, Nike was trading here 83.66 the day before. The next day, it was just trading 84, so no movement. But look at the implied volatility, it dropped to 28. So it was perfect in this example to sell that volatility. So if your crystal ball was to tell you the next day it's not going to move much in price, but volatility we know is going to come off, this is the way you trade it. So this one is one set up just to do that. It was based on the statistics that it doesn't have big moves. All right, so here was what it looked like. Going in on the chart, it was trading right here at that 83.66. And we were looking to this not to have a big move. The expected move up was right here, expected move down. And this one was set up just to play the volatility spike and volatility crush. So this one worked out well because it didn't move. So by selling that, it was a great trade. So it was trading at 83.60, expiration the next day, 83.95. So just flat, and that volatility we know is going to come off. So this one was taking advantage of that, and that was doing what we call an iron butterfly credit spread. So this is a pure volatility play. So you can see this trade was then basically doing the iron butterfly. The max theoretical profit, if you got it perfect at expiration, it went out exactly at the strikes that you sold, it had potential to make 292% return on your capital at risk. So set up for volatility collapse and price move of no greater or no less 5% up or down. So you didn't want a big price move. And so the next day, though, this was at $258, 252% in one day. So you can see your risk profile here. So this was a $4 widespread, $400, able to collect $298 credit from selling this iron condor credit spread. And so your potential profits, the credit received at 298, the potential loss is 102, which is the difference between the spread width and the credit you received. So pure volatility play here. So let's take a look at what this looked like going out. So the next day, it was set up with that high volatility. You were able to get $298 credit per spread contract. The next day, volatility collapses, and that implied volatility collapses down, and you can see the spread now went from 298, and it was trading at so it was trading 298 here, and then the spread was at like basically $40 the next day. So that was your profit there, that 298 less what you had left. So right here you can see that collapse. It just went almost straight to that top of the 10 of the profit zone here in a nice kept $257 there from that credit. So here you can see the credit was on the credit spread. The call side was 150. The put credit spread side 148. The put credit spread was at 0, and this one is at 40. So you can see the difference there. So basically what you're doing here is you're selling a straddle, basically. So you're selling it at the money call, at the money put, and then you're strangling it with the long call, long put here. So that's basically what an iron butterfly is. So that's a pure volatility play. So these are good if you have a situation where you have a high probability that the price of the stock you're trading is not going to have big movements. So you can just strictly sell volatility. But it's a capped risk trade too. So if you are wrong, you've capped your risk. Now the next one though is kind of my favorite. So this is kind of the go-to strategy that we've been using, again, due to the low risk to reward. So it's got a high reward, low risk on the trade. But the other thing is what I call flexibility. So what that is, again, is that it gives you the opportunity. You're not stuck with one trade duration. You have a longer trade duration on the long side, where if you want it, you could stay long, either a call or a put, and convert that to a spread or whatever to ride a post-earnings trade up or down. But you're also still getting the advantage benefit of selling at high implied volatility, which is going to reduce the cost of your long dated, because you're going to get the profit from the short dated that had the high volatility that you're selling, if that makes sense. So again, remember, conceptually think about it. We looked earlier as that example is CRM. Price was going up, but also implied volatility was going up. So as implied volatility is going up, and we sell that series of that implied volatility, we know it's going to come off. Now, so let's say we get $100 from that short strike that we sell, but we know it's going to collapse, and now it's only worth maybe 25. So we just made 75. Now, what that does, we made 75 there, okay, just for example, but we've got a long dated option against it, which is going to be not as high in implied volatility on the long dated, right? So that's going to be, so maybe that was priced at $100, something like that. And then we get $75 there from the collapse there. So we just reduced the cost of the long dated by the profit from the short dated volatility collapse, if that makes sense. So we're going to be able then to adjust into a long dated option, either a call or put, with a lower price than you would normally be able to get. So that's another advantage or flexibility that you have. So it's a low risk. Okay, so all these different strategies that I kind of pointed out, this will always have the lowest risk of any of the strategies. Okay, and then that's because of the structure. Now it's also set up going in as a non-directional earnings release type trade. Okay, so structured for low defined risk. You know what it is debit paid, but it's very low risk. Types of advantage, you get the pre-earnings advantage of high implied volatility. So you're selling the front end, which gets that advantage. You're taking advantage of selling time and volatility. And then you get the profit benefit from the volatility collapse from the short duration option. But this structure also allows to profit from any post-earnings trade trend, since there's a long dated and a further out duration that you can take advantage of. So you can set these up for a duration of just 1 day to 1 week is typically what I'll look at. You can make it longer if you want it. It's going to also always give you a positive theta, no time decay structure. So what sets this strategy apart again from the others is that not only are we selling volatility, but we can adjust the trade into a directional trade after an earnings release, and that gives you that big opportunity for a bigger potential profit from a post-earnings directional move. So I started using this back in 2020, kind of just figured it out that, hey, how do we take advantage of selling volatility? Well, we sell calls, sell puts, but how do we take advantage of reducing our risk, but also giving us the benefit to, if we want to stay with the trade longer, to take advantage of post earnings. So this was the combination put together, and it's been a real winner that we've been using ever since. So we used to use a lot of the other ones, but since this kind of developed, this has been the best because the risk reward is so low on risk, but has potential for great reward. So here's an example of one on JP Morgan last go around. So just going through the earnings stats here, you can see JP Morgan, will release earnings before the market opens. So let's say the JP Morgan will be earnings release on April the 14th. So that's a Thursday. Okay, so it'll be before the market opens on a Thursday. So you'd set this up Wednesday before the close. Okay, so you can see the statistics are here. So that's before the market opens. So the straddle cost, which is your implied move, basically is the history is $4.83 up or down, which would be 4.43% going in to the earnings release date. And you can see before that, it was about 3.89, 3.89. So not huge high implied volatility, okay? So lower type volatility trade versus when you saw, NVIDIA or Roku, they had like 212% implied volatility. So this one's great for this strategy that we're going to talk about. And then what is, I want to look, okay, what does JP Morgan actually do historically? So one day after expiration, earnings are going to be on a Thursday, Friday's expiration. So you can see not big moves, 1.66% up, 3.5 down, 3.2 down. The biggest one was here, 6%, but typically about 3% plus or minus 3-4%. All right, so that tells you, okay, well, this is not going to be a huge potential price spike, so let's just sell volatility. But if we want, and there's a post-earnings trend, we have the opportunity to stay long, either a call or put if we want. So here it was going into the earnings release date. The expected move was for a move of 3% up or down. That one day later, the trade was set for 3% up or down. So here it was, the trending price had been trending up. The implied volatility was, creeping up, and here was earnings. So you can see volatility does collapse and price moves up, but not too much. Okay, so it was trading at 139.49, and the exit the next day it was trading at 143. All right, so it moved up to 143, about $3-4 up, but still within the range. And so going into the trade, you'll see what this looks like. So it was trading at 139.49. Here's your implied volatility skew. You can see the one day expiration, the implied volatility was 75.49. Normal volatility is about 25. So that is typically what you're going to see. So that's what we call positive horizontal skew on the volatility. So elevated. So we can take advantage of that by selling volatility with this strategy. And then the next day, it collapses down. Now it's trading at 135.60. I'm sorry, it's trading at 143, but the volatility has collapsed down to what's normal. All right, so this is taking advantage of that. So this was doing the double lightning or double calendar. So with this trade, they look at the risk on this trade. The max risk, and this is a debit paid, is $79 per spread. So if you did one of this trade, and they're hard to lose because the break even so far out. So you can see here is a break even. So this was set up for a 3% move up or down. So it was doing selling the. If you look down here, this was selling the 13 Jan 143 call, buying the 20 Jan. So there's a separation of the date. So that's short dated 13, and then long the week behind it. So that's a 143 call. The total cost of this trade was $40.40 for this part of the trade, the call, the calendar. Now the other part, because we don't know if JP Morgan's going to go up or down, is doing the other side, which was a put calendar. Okay, so here you can see it was selling the 13 Jan 135 put, buying the week behind at 120 for $39. So there's your total risk there of $79. Now the max potential profit, if it went out at your calendar short strikes there, was 69 on that 79. So that's a typical calendar type of profit. But the thing that's so great is your risk is super low. If you did, like, say, if you did an iron butterfly or something like that, your risk is probably over 150, something like that. You just have to compare the two, but this will always be cheaper. Now, the spread then was trading initially at 79, and then going out, though, this thing was now at 136. So the spread increased out to 136. Less the cost of the trade, so that gave you a $57 per spread profit, doing nothing, just plain volatility crush, or a 72% return in one day. So if you look down here, you can see the spread when it was initially set up was $40 on the call calendar there. That blew out to 131. Okay, so that spread increased. The put calendar spread was at 39, that dropped to 5, and that gave you your spread cost of 136, net. And there's your cost there. So the key thing is look at your risk, but then potential profit, well, it was right here, 57, and that's doing nothing. That's just plain volatility collapse. So you're just sitting there, and the next day, that's where it goes out at the end of the day. And just like a credit spread, if your short strike is at the money or in the money, you close that out. The other one, you just leave alone, it expires worthless. So they're low maintenance type trades. So that's an example there. Now, this is another benefit of the double calendar, what I call double lightning. So this is to show you how you can get the benefit of adjusting for a bigger move post earnings. So this was on MU just recently, okay? So with Micron, the expected move going in this past week was 6% up or down. So this was set up for a 5% up or down, okay? So typically Micron doesn't have huge moves, but in this case it did, but we're able to benefit from the big move. So this was, it was trading here, and then right there was set up right there trading at 59.25. Now this thing then spiked up the next day. It was a big spike up, but when it was spiking up, adjusted it to just a long call, okay? And then you can take advantage of that because it's in the next series out. So it's not in the same series, okay? So this gives you that additional time if you want to play that for a big post-trend move up, or just, take advantage of the collapse and volatility from the short dated, which if you do it properly on your exits will reduce the cost of what you keep as far as your long dated. So it sounds complicated, but when you see and go through some examples, and I'll be doing a course on this next weekend, just a heads up that I'll be teaching you how to do this, okay? So I'm just giving you kind of a preview of some of the things you can do here, but we're going to be talking about that. So here's what it looked like just from a strict calendar. You can see this is what the structure looked. Here's your call calendar. Here's your put calendar. So the risk here you can see is total of $63. Now, you're never going to lose that full amount of your debit risk unless it was to gap up and never come back. And that rarely ever happens if you pick the right stocks. So with these stocks, you wouldn't do this with you probably wouldn't do this with like the Roku or the Nvidias that have these huge, big explosive moves, but there's so many others that have, big moves, but not as big, okay? But typically, you're never going to have a spike, a gap up where it never comes back. Sometimes you will, but not generally. And if you do, that's your max risk. But so what I'm trying to say is even if your max risk is 63, a lot of times you could close it out for break even or a small risk, maybe, $20 or a fraction of which your, max risk is. So that's what it looks like going in, okay? So, and then the next day, this spikes up. So you have that flexibility to adjust this and go with just the direction of, in this situation, the long call. So here was the going in on the 28th, it was traded at 59.25. The trade duration was the short cycle trade. The shorts were 31 March. The long duration was 6 April. So you had a shorts on the 31 March, which is selling the volatility part, but then you're long, instead of being long the 31 series, you're long on the 6 April, which is going to have a lower volatility, so you're not paying as much for it. Plus, it gives you the additional time if you want to stay with the trade for another week to go with it. And then you can go straight calls, call debit spread, call butterfly, call condor. And so the next day it jacked up to 62.50 on the open. It went up, closed out, did a bunch of adjustments where we just ended up long just 62 call with the adjusted price after taking the loss on the short call. And taking the loss on the long put, the adjusted price was $1.38 on the 62 call. Okay, so here down here you can kind of see it. If you can see here, so the original 62 call cost 99 cents or $99. Now the short call, the 62 call going in, had a credit of 68. Closed that out the next day, took a loss there, 68 minus 96. And then the put had a long dated put. The 6 April put was $100. Now, as this going up, closed that out, took a loss on that. So net, the loss in the additional $99 was your base price. And then with the loss and everything, that adjusted this to a cost of $138. Now, this thing blew straight up. And on the 30th, the next day after this, Now it was trading up to $222, even higher than that. So you can see adjusted call price 138, exit at 222. That gives you a profit at $84 per contract, or 60% return. So that's the example there. But then there's other things we can do. If we wanted, we could, if this thing kept trending, this one just gave you the opportunity to get out quick. But if you wanted to, you could have stayed with the trade, convert it to maybe a debit spread or butterflies or things like that. The 62.50 was right towards the open. So right here, you can see right here. So this, after you knew the next day it was going to be up post earnings, the market was closed, but after the market closed, it was trading way up. It spiked up way up. So the next day it gave you the opportunity, if you wanted to leg out, to do that. Okay, and then you can see it opened up, and then it was trading right in here. So it went up. Anyway, it blew. So you can see where it opened right in here and went up. And then the 30th, it was trading right there. So that gave you the opportunity, if you wanted, just to lock in that profit. So will every trade that you do be a winner? That'd be great if we could have every trade, but they won't. But what works is, then using again, kind of a systematic approach to kind of find these kind of highest probability trade setups. And here are some other examples just to show you of this kind of spread strategy. So again, what I call the double lightning, which is a double calendar. So here are a couple more that we've done. These were alert trade setups too. So I just kind of want to point that out. So since starting this alert trades on earnings trades, started this back in June of 2019, actually, and then through Friday, the trades closed, 112 closed out. Very selective on these, because you really need to, pick the right strategy for the right, stock based on its history. So these are very selective. So we've done 112, 83 winners, 13 break. A lot of these are break evens, because these are double calendars where if they're not winning, you just get out at break even. And then 16 losers. So high winning percentage when you look at that over the course of that time. And so here are a couple more examples. This was one on T-Mobile. So this was a setup on T-Mobile. Let's go through this one, just to kind of show you some more examples. This was sit out alert. So you can see here, it's a lot. When I send these out, they're very detailed. So even if you didn't know how to do the structure, you could just read this alert and it'll tell you pretty much how to do it. So I won't spend too much time, but you can see this says constructed to sell volatility in time. So positive implied volatility skew. Okay, so here I'll go through, I'll say that, okay, I'll give you the current kind of example. So at that point, when I sent this out, it was trading at 141.60. Okay, so then based on today's close, so the expected move was 4% up or down based on that. So bought to open at calendar, the 4 nov, 28 October. So you're going to be long the 4 nov, short the 28 October, 147 call. And that debit cost was about 59 bucks. And then shows you here, so long the November 4, 147, short the 28, 147. And so this is going in based on the close of the day, but these prices will be pretty close. And then the other part of the trade was doing the put calendar. So buying the open, the 135 put calendar, same kind of date structure there. So the total cost, was going to be about 59 for the call calendar, 53 there, $112 risk. So $113 total risk. And again, you will not typically ever lose the full amount, because your break evens are so far out, and these things swing back and forth. So that's your total risk going in. So then on the exit was the 28th. It was trading at 149.31, and so this was up $32 per spread, or 28% in 2 days. That's doing nothing. That's just sitting with the trade, taking advantage of that volatility collapse. So that's one way you can do it. Or if you wanted to, you could have adjusted it and gone long a call, long a put, or a spread, or something like that. So this is a pure volatility play, though, when these are set up. So here it was trading at right here, 140, 140, 160, and the next day though it was at 149. So typically T-Mobile doesn't typically have these big moves, but still this was even profitable with that big of a move. So if this had just set up here to the spread, which was set at 143 right in here, this would have been perfect. But you know, trading a lot of times is not perfect, right? So, but this gives you a lot of flexibility for it. So here was the trade setup. So we were long the call counter at 146. So that would have been the perfect place for it to go out, but it shot through it. So it was up here at 149. So you can see how forgiving this is. So even though it didn't go out at 146, this was still up of a profit of $32 per spread, 28% return. Now, if this had gone right here at that point, the potential profit was $200. So $200 on that one, but it was traded here, overshot. So it was still up, but still, you know, a profit. So that was in 2 days. That was on T-Mobile. T-Mobile's been a good one. We've done that a number of times. Here was another one that we did. This was on DHI, the one of the home builders. So again, this was set up as a double calendar, and it was trading at 73.15. Max risk set up 108. And so the next day at the 22nd, or 2 days later, it was trading at 76.72. And this was up $55 per spread, or 51% return. So again, same structure, just basically doing this just to sell volatility, just doing nothing else. And so you can see what it looked like going in and out. So the expected move was 5.77. Sit this up a little bit inside of that. So it was trading right here, and then it ended up going out right there. So not much of a move up. So that was actually pretty good, but the implied volatility, it came down. So that was taking advantage of selling that from the front short duration dated option, and along the back was lower volatility. And so here you can just kind of see the skew, just to give you an example of that again. So that 2 days expiration, 97.43, day after 53. So had that going for it. Set for expected move was 5.7, but set this up 4% up or down. Just selling this for volatility crush, but low risk and potentially good profit target there. So this went out right here. That would have been perfect. It went out right there, but still within a nice range. So again, max risk, you know, if you took the two spreads, 55 and 53, 108. And then when it was going out, the spread was 163. So it's $55 per spread profit, 51%. And that's doing nothing. You're just letting volatility play out. And then you just close it out, you know, just like you would a credit spread at expiration. Or, you know, or you can let it expire. It depends on where the price is at that point in time. And then here's one more that on T-Mobile. T-Mobile's been a pretty good one over the course of the different earnings seasons. So this one again was set up with a max risk of 124, and it was traded at 125. And I'll go through this one. It was trading at expiration on the 29th at 123.14. So down a little bit, not much. So it stayed kind of relatively flat, which was perfect. So this one had a really nice profit because it kind of was closer to our target strike, like a butterfly. You can kind of think of a butterfly, you know, for the kind of expiration. So this was going out really close to the short strike of the put debit spread, the put spread side. So here it was going in, and that was trading right down there at the close. So really good for taking advantage. So not much of a move. So we're really able to squeeze it out. So just again, think of a butterfly. If you were doing a butterfly, you know, you had your target here, that'd be your max, but it's going out here. So still a really good zone. So this was the call debit spread side 59, the put side 65. You can see the 65, the put blew out to 217, took a loss on the call side, but you had a big profit on the put side. So net, the spread blew from that 124 to blew out to 255, which gave you $124 profit, or $131 per spread, or 105% return. So the spread blew to 255. Just put that down so you can see it better. It was originally when it was set up, the spread cost was 124. So this is a debit cost. So you paid out 124. The spread blew to to 255, which gave you the 131 profit per spread. So you see the 59 call went down in value to 38, so you lost there. The put went from 65 to 217, you made it there. So net, that's where your profit came from. So that's the beauty of it. So, and then the other great part of it is that if you want to stay with the trade, you've got that opportunity because you have the flexibility on this one. You can see you're short the weekend, the 29th, but you're long the week behind it. So if you want to stay with it, you have another week that you can play it up or down. So it just gives you what I say, what I call that flexibility. So these are a great advantage to trading earnings, but these are great strategies for, we do a lot of calendars, not double calendars for normal market, but calendars are just great strategy in general. So I'd like to talk about more of what I'm going to be planning for next week. If you'd like to learn how to, take advantage of this volatility and the earnings season coming up. So we've got all the banks starting in the week of the 12th, 13th, 14th, which is right around the corner. So I'm going to do a course next Saturday to get you ready for all the earnings that are kicking off the week after. So this will be how to capitalize on earnings season uncertainty with low risk option strategies, focusing on the double calendar. But I'm also in the course will give you the other 3 strategies as well. So you can use those, and then it'll tell you, you'll after you take the course, you'll know which ones to use in the various situations. So it's a really extensive course. Let me give you the links, and so then we can talk about it, take whatever questions. So it's got a really nice bonus package. The package 1, if you want to do just the course with all the bonuses, use this link here, and you should be able to just click on this link here. I'll double check. So powercycletrading.com/1earn. And so you're going to get everything here that you see with this package. Just click on that link, and you've got that pulling up here and should be up shortly. You'll see it here. Here it is. So just click on that and you'll see everything you're going to get. 197. So you'll get all the things that you're going to get that. And there's also, if you want the indicators, if you'd like that, you can also add that to your cart if you'd like at checkout. So that's this is package 1. Package 2 will be if you want it with the alert service. But let's go through this package, then we'll go through everything that's in the course. So this will be start next Saturday, 11 a.m. Eastern, and 3+ hours. If you take my course before, I always go over because there's always questions. I like to make sure you understand everything. And but to start you off, as soon as you purchase this course, you're going to get my on-demand course of this. When I did it last time, turned out to be 7 hours. Okay, so you're going to get that right away, so you can start going through it. Now, every course, the structures and the strategies are pretty much the same, but then I go through with different examples and different tweaks and things that I've done. So, like I said earlier, I'm constantly learning these new things myself, and I'll see things that I think can help it, improve it, and so I'll add to it. So they always tend to get a little bit better each course. But if you look at the website, this course is $397. So you're going to get this just to start off. You're going to get also a 30-day trial membership to my trading club. And then you're going to get my Start Trading Options. This is a beginner's option course that I did not too long back. So you're going to get that as a bonus. Then we'll do a follow-up Q&A the Tuesday after. And then you'll get my kind of the Greeks, kind of pros, how the pros use the Greeks. So there's a printout you can put on your desktop. And then I'll give you a list for my trade setup list for these earnings. So these are the updated list of what's coming up based on 4 different screens that I use. And then you'll get the recording of the live course that will start next Saturday. You'll get the full trade manual of the course, which is about 428 pages. This includes trade, a library, all kinds of different things. And then you'll get the recording of the new course broken down in modules of 30 minutes or less. So really good, bonus package here for you, but the course is the main part, but I always like to give you some additional things that will help improve your trading. So if you'd like this with the alert service, this would be package 2. So if you'd like to actually get the alerts that I send out and have a little bit of extra heavy lifting done by me, picking the trades and kind of walking through with you on the trades and the alerts and the setups. You can use this link here. And what you'll get here is everything in package one, but you'll get my 4 trading alerts for the next 4 months, plus the trading club for the next 4 months. So you get that bonus of the alerts for 4 months and the trading club for 4 months, plus everything in package one. So with this package, there is a 2-pay. If you'd like to use that, you can see, click on that link, it'll pop this one up. So it's $5.97, everything in there, but also the alerts for 4 and the trading club for 4. And if you want a 2-pay, you're able to do that. So that's the package there. So you'll get my earnings option trade setups that I send out, any of those that are sent out, any breakout alerts that are sent out, any butterflies, condors sent out, any counter diagonals sent out. So you'll get all 4 of the different alerts that I might send out for the next 4 months. And with this package, or even with the 30-day trial membership, package one, you can start that whenever you want. You don't have to start it right away. And with this package, you can start and stop. So if you're going on vacation or you need to take a break or you're out on a business trip, just let us know and we'll stop your time and start it back when you want it. So very flexible on that. So with this one, you're going to get everything in course package one, but 4 alerts, 4 months of the trading club. So you'll get all that. So anywhere from 10 to 15 stocks. We do a lot of ETF trade setups. So we'll get selective text alerts on any option earnings trades that I'm sending out. Breakout reversal type trades that might be sent out. These could also be credit spreads. Any counter diagonals, we do a lot of those. Any butterflies or long condors. So any of those that are sent out, those are what you'll receive. With the alert service, you get a trading guide. It tells you what the trade, how to set it up. I do a video review of the trade after the close that day, that night, to kind of go through why it was done, what we're looking at there. These are archived. Then we'll do a Q&A. You have access to the Q&As typically every Tuesday, live and recorded for the next 4 months. Do a video newsletter every day after the close. You'll get that for the next 4 months. And then the coaching room, the trading club, gives you access to the trading room for every day during the week from 9:30 to 10:30 for the next 4 months. And that was what Kumar was saying has really helped him a lot, the trading room, to learn a lot. And then any courses or any of my software, you'll get 6% discounts for the next 4 months as part of the trading club benefits on that. So a really good bonus package there if you'd like to get that additional help in your trading. So a summary of the alerts so far since inception back in 2018, we've had 591 closed out, 442 winners, 34 break even, 115 losers. Still holding into an 81% win rate. Markets have been pretty choppy and volatile, so it's not been an easy market. So these have been very selective trades. We've been doing pretty good. So that's kind of an alert summary there. And then I showed you earlier the earnings alerts, just specifically breaking down this part of the service, still maintaining 85%, but these are super selective as far as the ones that I pick out. Now, here's what you're going to get in the course. So it's kind of a 2-part course. So the live course is what I kind of refer to as part 1 and 2. So this is going to cover, part 1 and 2 is going to cover the, right here, the 5 steps to the trade setup analysis. So a big part is selecting the right trade and then how to analyze it in the tools, my database that I use for it, to show you how that works and what it is and how you can access it to use it. And then, so you'll have the database, we'll go through in the course how that's used, set up your list to monitor what the screens and scanners are for it using the database, this tool. And then there's what I call a 7-step screening process to help identify the most probable winners. And then we go through the option pricing importance using these weekly options. The statistical resource that I use, we're going to go through that, how that works, how to use it. You'll get all that in the course, and then how then to set up your scans if you want to do it yourself to capitalize on these trades. Now, with the course, I'll be given a list that I put together, and we'll go through the list in the course and how it's put together. So you can have that or do it yourself if you want, but I'll give you the list as well. Then how to analyze these stock earnings release moves, post earnings, pre-earnings and post earnings, and what are the best strategies to look at there. What's the formula that I use to put these types of trades together to provide you the highest profitable potential based on, either selling volatility or maybe price spikes. But part 1 and 2 is going to be pretty much kind of dedicated to the double calendar, okay, and then the process and the resources and the statistics and how to analyze, and then that's going to be the live part of the course. Now, what you're going to get though additionally is the other part of the course will be on demand, but it's going to then be giving you the other types of strategies. I'll just go to those. So it'll be this part of the course be right here. If I can get my drawing tool. So this will be part 3. This will give you the other 3 non-directional option strategies that you can use. So the long iron condor, selling volatility, the long iron butterfly, selling volatility, the short iron condor for price spikes. So this course will be on demand, but it'll teach you with detailed examples of all these other 3 strategies. Okay, so it'll also give you the kind of earnings option strategy guide to use to explain how to use them, how, why, and when to use it, how to construct those trades based on this pre-earnings implied move and the statistics that we'll go through in the live course. So you'll get that. So that'll give you all the other strategies that you can use there. But then the main course will be this part 1 and 2, and then part 2 of the course will get into the specifics of the double calendar, which is kind of my go-to strategy. So really the best strategy I've found, because it's such an overall excellent strategy in general, because we can take advantage of high volatility to sell, but it gives us that flexibility. If we want to stay with the trade, we can stay with it longer during the long duration part of the spread. So you'll learn in depth how, why, and when to use this strategy, and my kind of a 10-step guide that I put together to follow. So details that cover the earnings double calendar, how to choose the optimal stock strike prices, how to structure the initial setup through option expiration with ease and perfection. Then the big part is how to adjust. If you want to make the adjustments, how do you do it? And what we try to always achieve, if we can we adjust to a free trade, what that is or how that's done with 0 risk. So these are really a great strategy that gives you that flexibility to stick with the trade, and sometimes we can adjust to a 0 risk trade. So that's everything, kind of what the course covers. Then when to use the other strategies, when to set them up, how to manage, how to defend, and you'll get a trading library as well with it, so you can go back and look at past trades. The live course will be next Saturday, the 8th. And I know it's Easter weekend, but it will be recorded if you can't make it. Plus, you're going to get the on-demand side of the course, but it'll be back up here. So it'll be next Saturday, the 8th of April. Okay, 11 to 2. Typically, we'll go longer. And then we'll do a follow-up Q&A the next week on Tuesday, the 11th. Okay, so everything is live, but also everything is recorded. And plus, you'll get all the other, additional bonuses that I pointed out. So that's pretty much everything. And then you'll get a trade library, so you can go back and look at a lot of different old trades that were done using these different strategies, Apple, Google, all kinds of different ones that we've done in the past, how they worked. Here's a little feedback from Mary, just kind of give you an idea of the course, how it went. So Mary says, the course explained in clear and simple terms how to trade options on stocks that were coming into an earnings report. Larry showed the specific sources of information used to determine the strategy, which strategy is the most appropriate for your stock that is reporting based on the historical data, gave specific guidelines as to the use of each and also the exit strategies, goes over the material in great detail and shows examples of the strategies from past performance. One thing that impresses me with each course I've taken is his willingness to repeat explanations if someone asks for clarification. He schedules the classes for a certain time frame, and because he wants to ensure each participant has understood the information, he most often goes over the planned time because of the, he stops to answer your questions. So that pretty much summarizes what I was trying to say earlier. So, we'll set it for 3, but, typically these could go over because of, I'm stopping, taking questions, going through examples for you. So the enrollment bonuses, here they are. We'll go through real quick and take whatever questions. So yeah, here, John, here's that link again. Here's course package 1 right here. Okay, so with the on-demand, you're gonna get that right away. So it's a comprehensive 7-hour course that I did in the past. You'll get the detailed PowerPoint training manual of it. This will go through the weekly option strategies, the 4 weekly option strategies. It'll go through the double calendar, iron butterfly, long condor, short iron condor, with the earnings guide, trade examples of the strategies. So very extensive. So you get that to start with, but then we'll get into the live course next Saturday. So that's bonus 1. Now you can start right away this week, starting to, kind of climb the ladder and kind of learn what's going on and be prepared for the course if you want. So bonus 2 is you'll get a 30-day trial membership to the trading club. Again, you can start this when you want. So that gives you access to the virtual trading room every day during the week, 9:30 to 10:30. I do a daily market video update newsletter that comes out after the close to tell you kind of my perception of the market, what's going on. Then we have trading videos that are archived. I do a weekly live Q&A every Tuesday, typically, which are live and recorded. There's a nice educational vault that you have access to and discounts 60% off on all courses and software on the website. So you'll get that as part of the bonus there. Yeah, sure, Ross, here you go. Yeah, if you've taken that to a 4, you can definitely join us again. So let me give you the link there, Ross. Hold on. Please do join us. So this is a course, that a number of members have taken over and over and over because, it's an interesting course to say the least, because not too many people know how to use these strategies or even know about the strategies. So, even if you don't want to, you decide, hey, it's not for me, at least you explored it and gives you the ideas. So whether it's something for you or not. So that's a great way for you to go. The 60% discount, you can't use the 6% discounts on the live course. Okay, it's just for anything on the website. Okay, anything on the Power Cycle Trading website. So I can pull that up in a minute. But the live course is $197, with all the bonuses, and you don't get the discount on that. So you're also going to get my on-demand Start Trading Options today. So if you're just starting out, or just add this to your trading library, a really good course to get you started trading options. So the benefits of options versus stocks, insider tips on options, the option basics, the mastering puts and calls, expiration, how that works. And then it also goes in this course 3 different strategies that I teach in the course. The cover call goes through strategy 2, the protective collar strategy, and then just a vertical debit spread to get you started in the resources. So really good beginner's course here, kind of beginner to intermediate course for you to get you started with if you need that, or just to add to your library. And bonus 4, we'll do a follow-up support Q&A, which will be live and recorded. Then again, you're getting a 30-day trial membership that you can come in the trade room, ask whatever questions. Then you'll get my How the Pros Use the Greeks, 60-page option guide with videos on the Greeks, delta, gamma, theta, how option pricing works, standard deviation, how that works, option delta, trade probabilities, things like that. So more on your option trading there. And then I'm going to give you 4 earning stock lists. So this will be based on 4 different screens. And in the course, I'll teach you how to do the screens yourself and what I use. So this will give you these screens based on stocks that tend to have a tendency to move greater than 5% up or down, and then stocks that move no more than 7 or 5%. So, and plus my favorite earnings trade set list. So you'll get those 4 lists there. But you're going to learn in the course then how to do it yourself, so you can do it down the road if you want. So, you'll get this watch list here is from a past one. So this one shows you a list of max 5% moves back. This was, just July, but these were the ones that had a max of a 5% over the last, I think, 4 cycles. So it just gives you a list of those when the earnings are after the close or before the close, average volume statistics there, things like that. And then list 2, max 7% move over the last 4 cycles, give you a list of those when their earnings are, et cetera. Max 5% or 3%, 5% right, greater, list 3 is greater than 5%. So they give you that list, and then it gives you my favorites here. So a lot of the ones that we've done in the past that are kind of go-to that are favorites to come back to again. So you'll get that list updated. And then if you want to add it to the elite service, you can do that. Let's see here. Hold on. It says, good day, Larry. Just chiming in to reaffirm as I have previous your education delivery. Oh, thank you so much, SS. So here, if I may pass this on, I appreciate that. Here's from a past happy member. Hold on, let me put that in. I appreciate your compliment there. Thanks, God. Thanks again for that. Yeah, you'll get the actual hard copy of the guides. Yeah, you'll get everything. You'll get the full PowerPoint. You'll get the list. You'll get everything that I'm giving you in the course. Yeah, the live sessions are recorded. Yeah, it's always going to be recorded. Then I like to break the sessions down in modules, like a chapter book of 30 minutes or less, so you can go back to whatever area that you need to concentrate on. Okay, so here's the link again for course package 1, and then we'll go through the alert service, which you get there, and then any questions you might have, be happy to answer them. So here's the link there for you. And then if you want the elite service added on to it, here's a little feedback from Dan just recently. You're very diligent and totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you when I was learning how to trade options. Please feel free to share this with other participants. And from Scott, another member, it will be the best investment that you will ever make. Go with the elite package, great group of traders in the trading club too. So here's the link here if you'd like that. So you'll get the 4 alert services plus 4 months to the trading club and 4 months to the alert services using this link here, plus everything in this course package that you're gonna get next for this week and for next Saturday. So with this, you're gonna get the 4-month alert service, 4-month trading club, everything that you saw in course package 1, all the bonuses, the course, typically look to do, anywhere from 10, 15 stocks or ETFs a month on the different alerts that are sent out. These are very selective alerts that I send. I really try to focus on finding the best trade setups. So for either earnings or breakouts, which could be debit spreads, credit spreads, calendar type trades and diagonals, butterflies and condors. I'll show you some examples here in a minute of some that were sent out here as well. With this alert service, you get the suggested option trade, what's the entry level to go in, profit targets based on what I call unusual option activity or what I call price target mapping, what option series you should use. Some members just do their own thing. They just want the trades, because I really focus on trying to find good trades. So a lot of members do their own thing. They just want the trades and they go about it their own way. But I always give a set option strategy to use if you want. With the stop loss levels, guidelines, trades are listed and archived. Like I said earlier, I do a setup video review of the trade after the close. Then I also have a video newsletter that you get, for each day after the close, which gives you the kind of my perspective, my overview of the market, anything we're doing during the day. We do a weekly Q&A, so you'll have access to all this for the next 4 months, and virtual trading room for the next 4 months, 9:30 to 10:30, Monday through Friday. 60% discounts on all courses and software on the website in the educational vault. So you get all that good stuff. And if you do want to go check out the website to see what you would get, let me just kind of show you real quick where to go, and you can just see all the different benefits you'll get from the website at 60% off. So if you have any questions about any of the other things that you can get or access to, just go to my website here, powercycletrading.com. And you can see here, if you click here, courses, it'll give you trading courses, boot camp. So if you want to look, a lot of the boot camps I've done, how to profit during a bear market. So this is a course I did there. So you'll get discounts off on all this, all these other courses that I've done in the past. Here's one, how to identify and trade breakouts before they happen. That one I just did. This is one I just did recently. This was how to do breakouts and reversals using options. So with all the indicators. So just go through there, see what you want. If you want any of this stuff additionally, then you can get all my trading software, 60% discount off with your members discount. So just check out the website for anything you need there. And then you have access to the trading club trading room each day during the week. So you can get in and, log in there. So that gives you access there. So the trading club, with the alert service, kind of went through earlier the results, but we've been able to maintain pretty high winning percentage even in this market. It's been a pretty tough one, but been focused on trying to find the good ones. And so that's alert there. And so here's the earnings trade alerts. This was KG. I think KG, man, he's done the course 4 times, I think. But he used to just do every earnings trade. He was just fanatical about it. He did really well on them. And then the earnings alerts, if I can talk, 85% winning rate so far. So these are very selected. Here's some examples of the counter diagonal alerts that are sent out. So we do a lot of these in the club. So here's a summary of these trades since back in 2019 to current. So we've had 198 trades closed out. 151 winners, 9 break even, 38 losers, 81% win rate. And here are a couple examples of some that we've done in the past. Here's what we did on XRT, the retail ETF. Now we had this long put calendar, and so we set this up as a calendar. So it was traded at 67.74. Now we adjusted this one also to a long put condor free trade. So I talked about that in the presentation. So a lot of times we'll try to do that, but here it was just from the calendar. So we took profit on this calendar. We set up on the 23rd and then had a profit take on that and then adjusted it. But here's the calendar side. So here it was going in. You can see the trade set up what it looked like. It was trading right here. We were targeting down to the 66 strike here. There's a lot of support there. So we did the initial trade per calendar, then we adjusted it. But here it was on the calendar side, and we flip through here real quick and I'll show you what that looked like. So here it was going out. So set this up on the 23rd, starting with it as a calendar. So at 67.74, and then took it off from a profit point for the calendar the next day, $44 on the spread, 44% return. But then the additional trade that we had on there, we adjusted this trade to a long put condor, which I'll show you in a minute. But so the initial trade, a lot of times what we'll do is we'll start it out with the counter diagonal, take profit, maybe adjust. And so the initial trade was this one, and then we adjusted it to the put condor, because these calendars are great, because you can see here, it's just like what we're going to do in the course on the earnings. This was short the front end and long the back end, so the 10 March. So we can play, a longer duration trade to stay with the trade if we wanted. So it gives us that flexibility. So that's an example there. Here's just another example of another one we did. This was on the Russell 2000, a put calendar diagonal. Now this one was a killer one. This is, typically singles, doubles, but this one was a major home run. So this one was one that we did and then adjusted it for a bigger move. And, without spending too much time, it was set up here, and then it crashed, and we were able to roll the whole spread down, which adjusted the cost into basically a credit. All right, so I just did this course recently, which taught exactly how to do it. But we took the initial trade and then adjusted it, and we're able to adjust it to a free trade where we had zero risk. We actually had a credit of 65. And this one went out making, we had the profit takers up $300 on zero risk. So just want to show that one as an example. Here's a couple of butterflies, long condors. Now here's one we just did last week on Microsoft, still in this, but just we'll show you kind of example of it. So with the butterfly service, you'll get these alerts if they're sent out. So we've had, started back in 2019, 123 closed, 91 winners, 6 break even, 26 losers, 79%. Now these are really low risk for all the different strategies, anywhere from 50, maybe 100, $150. But typically, we'll use a stop loss. So the average, you might lose maybe $50, $60, but you have 2 to 1, 4 to 1 or higher when you do butterflies and these types of trades. So it gives you a really good positive risk reward type ratio to add to your trading portfolio. Here's one we just did last week. This was on Microsoft, which this one's still open, but we did have some profit take on it last week. So we set this one up on, this was set up on Wednesday, the 29th. It was trading at 280.40. So this was Microsoft looking for a break to the upside. Now here's your risk. So we want to do a low risk trade. So set this up with a max risk of $73 per butterfly spread. This has potential this next week on the 6th of April, Friday next week, to make, theoretically, it could make $427 or 585% return on that risk of 73. Now we did take some profit this past week on it. If you did, if you had multiple contracts, I'll update you and say, okay, take some off. So you can see here was the trade setup we did. This was basically right here, the summary, just so you can see it. So this was buying a butterfly. So buying the 6 April 285, 290, 295 call butterfly at $75. And then sent out alert to take a little profit. So this was just on the 31st. This was a Friday. So it was trading up to 284 and then up to 287. So this was up $60 per spread. So take some profit if you want, if you have multiple contracts, and hold the balance. So just constantly try to keep you alerted to what's going on if you're not at your desk. So this was a really nice setup. So the setup on this breakout right here, targeting 290, and that's kind of where we're at. So we set this trade up, and you can see the structure here. So it's long the 285, call long, short the 290, and long the 295. Total risk $73 on the butterfly, and potential to make 427 or anywhere in between. But currently up about 60 bucks when we went out Friday. So not a bad return, actually. $60 is 87% return in 3 days. So this was where it was going or trading right into Friday right there. So you can see it's flat, but it has all this potential profit in there if we get this move to 290 closer to next Friday. So a nice structure there, low risk for this kind of market. And here's another one. This is one I was talking about earlier. This was XRT, which started as the put calendar and then adjusted this to a long put condor free trade, just to kind of show you. So with the alerts that I send out, I tell you how to do it. Sell to close this, buy to open that. And so the way this ended up was trading it into a free trade. So it went down, first one, targeting 66. I showed you that earlier, took some profit, and then adjusted it, the balance, if you wanted to do it, or you could take profit on the whole thing, adjusted this to the long put condor. So basically you can see how this ended up. And this is what we'll do with the earnings types trade. So the long duration option was in the 10 March. So we adjusted it and ended up then going long the 10 March 66 put at an adjusted price of 70, then short the 65 put at 70. So that was zero cost there, and then sold a credit spread against it to make it a condor, which looks like this, and it was a free trade. So we had this set up at a $17 credit actually from that adjustment. And in the earnings type trades, this is kind of stuff that we'll try to do if we want to hold a trade past the earnings date. We can do these kind of things with the calendars. All right, so ended up going out right in here. So and took profit right there. So it went out on the 9th, trading at 64.53. So Went from a 17 credit to $52 debit, $68 profit, 0 risk. So that's just kind of give you kind of some ideas of what you'll be getting with the alert service and everything there. So let me see if I missed any questions here. Yeah, oh yeah. So question here is, yeah, that's the purpose of the alert service. Good question. So yeah. Oh, you're welcome. Yeah. So let me see. Just thanks, Rick. Yeah. So Klaus, yeah. So that's the purpose of the alerts, to guide you through and kind of keep you, help you navigate the ups and downs if there's anything going on. So there's with this kind of market, there's all kinds of things that have been happening. So yeah, send out the adjustments constantly during the day. I'll update you on the trade. Yeah, so will the double calendars also work on stocks that gap up after the earnings? Yes, they will. And that's exactly what happened with Micron. It gapped up, but the thing is, it gives you, if it gaps up, if you were just short a credit spread, let's say on Micron, when it gapped up, you had no other choices or no other options but on the trade. But if you had the counter diagonal, then you had the chance to adjust it. So the trade was set up right here, and then you can see it. This one didn't gap up, but it had this big spike, and so adjusted it there. But if it does gap up, the one thing is that your risk is super low, and typically they'll come back and fill that gap, so then you can do some things there. But yeah, so you can. And so I'll pull up the alert. So here's what it looks like. Last week we had so the alerts I use what we call Telegram here, and we had here last week we set up. We had XLB. We ended up stopping that out trading. That was one that went against us, but we had a very low risk trade on that because we did this as a calendar. But last week we had a new Amazon trade, Microsoft trade. But I'm constantly giving you, if there's an adjustment, I'll send those out to you by text, and these get out to you within seconds. With these types of earnings trades, the option markets won't be open after the close, so you're going to just have to do it during the day. So the question is, are the earnings trades played during the session? Yes, they're played during the session. And can they be set and managed after the close? No, because the option markets will be closed. Do you need Thinkorswim? No, you do not. It's just the platform I use. I mean, you can use any of the option platforms. It's all it's all the same, all the same mechanics between the option platforms. They're based on what we call the Black-Scholes model, so they're all pretty much the same. Yeah, Kumar, you have a great weekend too. Yeah, David, if you'd like to upgrade, you can. We can just let me know, and we can just adjust you to the other package. You paid 197. We'll just do the difference, and you can upgrade to the other package. That's not a problem. Did I miss any questions? Because what happens with GoToWebinar, it scrolls down, so sometimes I miss them. Okay, Alex, yeah, so you're picking up the options better. Telegram is a text service, yeah, over the phone. But if you want it by email, we also do that. It takes a little longer because my assistant will I'll send out a text, and some people like it by email. If you want that, we will send it to you by email as well, so you can have both. Phone is the best, yeah. I mean, it's there within a second. It's a really good little tool. Yeah, William, yes. So as a member, question is, William has one of my courses, the Butterfly Long Condor course. Is there a special pricing to join, purchase your other packages? Yes, there is. So if you're a Trading Club member, so if you're a member of the club, so it's $97 a month if you stay on, or if you have that 30-day trial, you can use it at no cost, but then just go to the website, Power Cycle Trading, and you can buy anything on the site, any of the courses that I have, using your members discount, and you'll get 60% off. So here you can see that the bonus you're going to get started trading options today. That's a bonus for the course. This was just done this past February, but if you didn't have that course, you want it, you go here, and it's $197. But as a member, you would get the 60% off. Here's the Ultimate Option Guide course. This is a great course. Did this last May, but if you wanted this course, you just go through, see the details of the course, what all it gives you. It's $597, but if you want that course, you'll get 60% off that. Here's cycle trading breakouts using futures, insider secrets, trading technicals, capitalize on options for income, profits, and hedging. Just completed this one. This was just done in March. And if you want to buy that one, it's on the site. This is $397, but you'll get 60% off that with your members discount. Here's the calendar course. Just completed this just last weekend. So on the site, this is now listed for $397. You'll get that 60% off. Here's the earnings course that I did last go around. If you were to come to the site, this is $397, I believe. You'll get that 60% off. But now today you'll get it for $197 with all of the different additional bonuses. So it's a much better deal to do it right now. Yeah, so you should use this link here. Join us for the course this next Saturday. You'll get, as part of your bonus, you'll get the 30-day trial membership to the Trading Club. And even if you don't decide to stay on, which hopefully you will, a lot of the people do, for the next 30 days, you can buy any course on the site, and you'll get the membership discount code for your 30-day trial membership as well. So you can go buy anything on the site at 60% discount off. So you just use that link. So with that link, you're going to get everything here you're seeing, plus 30-day trial membership